I'm actually in Columbia, South Carolina right now. And Holly, where are you like right now?
I'm in my house in Woodstock. I'm in my little cozy mountain chalet.
Oh, that's awesome. That's
It
awesome.
is awesome. It's pretty awesome. But I do have to drive back to the city today. We're actually going to Lubbock, Texas, believe it or not,
Good old Lubbock.
Yep. I'm here on my lunch break. There you
Which
go.
is bigger, Lubbock or Amarillo?
Lubbock.
By how much, do you know?
A lot. A lot. A lot.
Always been curious about that.
Yeah, I think I told you one of my best friends is a pediatrician there, and her parents are big donors to the school or whatever. And so Texas Tech is playing Baylor in Dallas on Saturday.
Wow.
So we're going to Lubbock, and we're driving with them, the whole family. We're driving with them to go be in their box. It ought to be fun.
That'll be fun. That'll be fun.
I'm trying to get my daughter exposed to.
All right. So it says we have somebody on their lunch break in downtown Minneapolis. That's Jason. We got Jim from Greeley, Colorado. Welcome, both of you. Have a couple more people that have joined us. So as you guys are joining in, you will find the chat box there on the Zoom bar down at the bottom, and just type in there. Let us know where you are dialing in from. It was interesting, Holly, because I had somebody pick up our link and post it on a Facebook group that's geared towards people who are currently in the W-2 job and they're working their way out of it. And they posted your link into that platform and to the webinar today. And they said, well, they didn't really pick a very good time because 1 p.m. is in the middle of the day for most people who are working. So it's hard to have them go watch the webinar.
Yeah, figure they're trying to get out of it, so they can pretend it's something for work.
Right? That's probably a good thing. There you go. Well, we also have Alec here. Alec from Chapel Hill, in between his classes in school. I remember meeting Alec at a meetup a couple weeks, probably about 2 months ago. I think Alec and I met. So thanks for joining us here, Alec. Got John from Warsaw, Indiana. And so as you guys are joining in, please just let us know. Find the little chat box at the bottom on the Zoom link there, the Zoom bar, and let us know where you are listening in or dialing in from. I have a couple more people falling in here. And we will be, of course, recording this and sending it out afterwards. So if you can only stay on for the next 20 or 30 minutes, need to jump off to go back to work or whatever, go back to a class or something like that, feel free to do that. We'll make sure that we send it out to everybody who's registered. And we have Michael here, Mike from Raleigh, North Carolina. So we have people from all over the country. So that's pretty exciting, Holly.
I'm telling you, all good places too.
Yeah. Well, let's do this. It is 1 o'clock now, so I don't want to take away from you at all. And so as people are continuing to fill in and funnel in, I'd like for us to first kind of get started by talking a little bit about your background. So, can you kind of give us a little bit of a background about, who you are, where you've been from, and all that kind of good stuff as well?
Sure. So, I grew up in Texas, but what brought me to New York City 30 years ago, actually, 28 years ago, actually, was a job, a W-2 job in advertising and media and market research. And I loved it. I loved New York City from the day one. And so, about 3 or 4 years later, they stopped asking me if I wanted to go back down to Dallas. And I met my husband, and I've become this New Yorker. And all along the way, I really liked my job. I had a nice career and worked with a lot of good people. And so I didn't necessarily want to leave it until, recently, until real estate kind of took on a life of its own. And so slowly I began to transition. So I'm excited about this because you can do this without working at it. You can still focus on your full-time job while you learn and build a real estate portfolio.
Yeah. So one of the questions that I'd like for you to answer too is obviously, going through, working a W-2 job along the same lines of doing this, a lot of people, have that struggle of determining when is the right time to try to exit, and is it really necessary to exit right away, or are there some things that you can do that you can still work your W-2 and do these types of investments?
You want to answer that now?
Sure.
At least for me, I think, we know more about us than we think we do, right? And I know that when I trust my gut and really trust my gut, it's time, right? And I knew it was time probably about a year ago, which is why one of the big, motivators, I guess, to launch Keep More, do the things that I've done in the last 12 months. But prior to that, I was investing in passive real estate, and I loved it. But the more I started talking to people about it, people in my little orbit, hey, what are you doing? I told them, and I got them involved, and changed several lives, right? In addition to mine. And so I got to a place where I was okay with the income I was making. And then I tried just saving the W-2 income and living off of for several months, and I did fine. So I said, why am I doing this? And so I really want to spread the word here, because this is the big secret. This is a secret. The financial services industry is great, but they do not want you to know this, or they just don't know it themselves.
Mm-hmm. No, I think that's totally correct. I mean, there's a lot of consultants and financial advisors and CPAs out there that really don't know a lot about this space. And so as you start to get down the road in your career and you start to have some money to be able to invest, a lot of times these types of individuals don't really have the knowledge it takes to really take you to the next level when it comes to this stuff. So I'm glad to have you on here. Looking forward to seeing all of the knowledge that you're going to be able to provide for us on this webinar. For those of you who are on the webinar with us, throughout the webinar today, if you have any questions for Holly, in the bottom of the bar on Zoom is a little button that's called a Q&A button. If you'll just type in that Q&A box any question that you have for her, at the end we will answer as many questions as we can, time permits. So the plan is to have about 20 to 30 minutes of content from Holly, and then afterwards we will do some questions and answers with her afterwards. So, and again, Holly, if it goes longer than 20 or 30 minutes, it's perfectly fine, but I don't want to force you to have to go for an hour if you don't need to go for an hour. So I know you have quite a bit to go over today, so I'll go ahead and turn it over to you, and I'll go ahead and advance to your first slide here. Okay.
Great. So Dan, thanks so much for having me. Thanks to everybody that joined, taking time out of your day. You're supposed to be working, but I won't tell. So my title here is really how I made the transition to full-time syndicator from a W-2 job. But really it's about how I discovered how to pay less taxes, keep more of my money, and really live better, and that's what passive investing has done for me. And I am not a financial advisor. The disclaimer is right down there. I do not, this is only my experience. It reflects my particular tax situation. And before you do anything, you should consult your tax advisor. If you consult a financial advisor they'll probably tell you not to do this because they have a vested interest in selling their stuff, or they just really don't understand it themselves, or they don't know about it. Because what I'm about to talk about is not something that's publicly available. So really can't advertise the details. You really have to have a personal relationship with whoever is offering these syndication opportunities. And so I went through life and I didn't know that it was possible to do this. And once I did, then I discovered, what I think is really a fabulous way to get income, and not what we were brought up to, or at least me, not what I was brought up to think about in my family. And so the minute from the get-go, I was skeptical. Most CPAs that most good CPAs will tell you, yeah, do it. And I'm like, why didn't you tell me to do this before? And he said, well, that's because I don't know of any, you know? So it's really interesting. So it's an opportunity that I felt like it was almost my duty to tell my people that I love about it. And so as I started to do that, one thing has led to another, and here we are. And so now my mission in life is to really enjoy my family and enjoy my quote unquote retirement, and then to make sure that everybody I know, understands these investments and has the opportunity to participate if they are an accredited investor, which is a whole other topic. But and some of these are open to non-accredited, sophisticated investors, but most of what we do is open to accredited investors. And, the SEC says that I can't even tell you the details of a particular deal unless you're an accredited investor. So that's part of the club too. So today, I think I just covered this, 30 years in corporate life. I loved it. I worked for big companies, worked for startups, was an early employee relatively at AOL, was mostly in media market research and analytics, right? Online, I got into the first .com thing. So I knew about real estate investing. I read Rich Dad, Poor Dad. I had, a couple of single family homes. I had bought a Manhattan apartment, blah, blah, blah. But it takes a lot of time. I mean, real estate investing is not, you have to find the deals, you have to analyze the deals, you have to go wherever it is, because in New York City, where I live, it doesn't work as well. It's a lot harder to get into, and the cash flow doesn't work if that's what you're trying to get, which is my whole objective in this is cash flow. I want cash flow to live on. You can invest for appreciation. You can go in so there's a lot of ways to invest in real estate. You can invest in there's a lot of different ways. But what I've found is when I found passive multifamily syndication opportunities, which means going in as a partner, a silent partner, a limited partner with people that know what they're doing, a big aha moment happened for me. And the risk of a single family home, you lose a tenant and you're out a month's rent while you get it, all kinds of things can happen. What we do is we mitigate that risk, or a lot of risks actually, but one of the risks we mitigate is if you have a 300 unit apartment complex, if a couple of people move out, it's not the end of the world. So it was too much work for a full-time job. I discovered the power of passive investing through an invitation, and that's what it is, right? An invitation. I was invited to participate in a multifamily partnership about 5 years ago with a friend. You may know him. His name is Joe Fairless, and he had never done one before. And he called me up and said, "Hey, I'm doing this. I'm looking for people to help." And I invested with him, and I did it really not understanding what I was doing, but knowing him very well. And that's really kind of, so I learned this by doing it. And I recommend that, actually. I recommend learning this by making an investment and really seeing it for yourself. So, okay. So I'll tell you about that. So I covered a lot of this. So, I cannot stress this enough. These are private offerings. If you go to your financial advisor, they will probably tell you to not do it. My financial advisor told me, "Holly, you're making a big mistake." And that is a quote. And this is somebody that is a friend. I mean, I still have money in the stock market. I still have money with him. He's a friend. I've made money, all of those things. And now he's happy for him. I was honest with him and said, this is, but it's not his thing, right? He makes his money by, charging a management fee putting in mutual funds that even if you ask them straight up, they'll tell you, oh no, the only 1% fee, you're only paying 1%. You're paying for that mutual fund. You're paying those people to buy and sell the stocks, give you advice, all of the things that a mutual fund does. You're paying for it. And one of the things that, and people don't put it that way. They don't phrase it that way. Somebody's paying for the big buildings in Manhattan. Somebody's paying for this, and it's coming out of your returns and my returns in mutual funds. And so the more I learned about, passive deals, it's, you're paying fees, but you're not paying anything like what you're paying, I laugh because the paperwork for a passive investment like this is, Dan, I just did one for you, 50 pages or something, he's probably muted. And,
I was muted there, but yes, it was actually about, probably closer to about 75 to 100, but right. It was still not nearly what it was on some of those other ones you've seen.
I urge everyone to go online and get the terms and conditions for a mutual fund. Now, I'm not down on mutual funds. Like I said, I'm still in them, but they only, most of the play, I can't even find a full one. You have to call the company, Fidelity or something, and ask them specifically for the entire terms and conditions. And oh my God, I mean, it's pretty crazy. So the paperwork involved scares people, but it's not. It's just because we're conditioned to not ask these things. We're not, as a country, at least me, I was not financially educated, and we're brought up to think, put your money in the stock market, put it in a 401k, listen to your financial advisor. And, all of these people are human, and they can't know everything, and they can't know everything about what stocks to pick either. And they'll willingly tell you that they don't know what's going to happen. And so it occurred to me that most of my net worth was in something that I fundamentally didn't understand, and was with people making decisions that didn't understand it either. I could tell you about P&E ratios and all that stuff, and that's not understanding. Understanding is understanding, I love Apple, right? But I don't know the business. I don't know what their margins are. I don't know what the trade agreements have to do with it. I don't know. There's so much that I don't know, and that's what's happening on Wall Street, is that I can't understand all these industries. And so what I've done is learned about multifamily real estate, and I understand it. And I understand how the things that we can do to mitigate risk so that cash flow still happens. Everybody listen to that. Cash flow still happens if something bad goes wrong in the market, which it probably will at some point. I mean, so I don't invest for cash, for appreciation, or even worry about the market, because what happens when the market goes down, and what happened in 2008 was rents actually went up because people lost their homes. They needed a place to live. So there's a lot of things. We buy properties that are already cash flowing. So, to me, it's a lot less riskier than buying a stock. That's just my opinion and what's happened to me. So the more I learned about this, the more I said, well, this is what we need to do for retirement, right? So go back one slide, Dan. Let me make sure of something. Go back one slide. So yeah, I'm gonna just cover this just for a second, because one of the things that happens, and everybody says, is this a REIT? And that's what I thought at first. And a REIT is nothing but a mutual fund that buys real estate. Now, there are private REITs also, but I'm talking about public REITs. And what happens is that most of the tax advantages, you just own a mutual fund. You really don't own the real estate. And what syndication allows you to do is to actually own the real estate just like if you bought a house or whatever, but you don't have to do any of the work. And so what happens is that as a group, all of the benefits of a rental property. So the government lets you take off depreciation and lets you take off expenses against the income and all of this. So most of the time, in fact, all of the time, for every one of the deals I've been involved with, there's been a tremendous paper loss at the end of the year. So I may make cash, $8,000, $9,000, $10,000 distributions, but I may have a loss on my taxes of $20,000. So once I discovered that, with a mutual fund, I tell people about my $65,000 tax bill, and I had money in mutual funds, and I got a 1099, and it said, congratulations, you've made $65,000 and you owe capital gains taxes on this, which amount to 20 grand or whatever. And I'm like, I didn't take any money out. What are you talking about? And so that's the difference. So it's a big difference. And then there's this thing called a 1031 exchange that sometimes, not all the time with these, but if you're with a group that would like to do a 1031 exchange, you could do that and then roll it over into another investment. And so I've done that a couple of times now, and that's been really great as well, because my principal has gone up, plus I've made money during the hold period, if you will. So, and then passive losses offset passive income. So this is, when Jared Kushner, when everybody was up in arms that he doesn't pay taxes, I don't know, I haven't seen his tax returns, but I'll bet the farm that these are the kinds of things he's doing. And you notice that the brouhaha kind of has calmed down. It's calmed down because our lawmakers are doing this. They wrote the laws, right? So, I have every right to get the best, write off everything I'm entitled to. And so the tax benefits of this for me have been incredible as a W-2 earner. Now that you can't offset that income, there's nothing I can do about that. But I certainly offset a lot of other income, which you'll see in a minute, because I had passive income in other places. And so I'm getting cash flow, at least on the real estate side, without paying much tax, which is incredible. It's just amazing. So, and if you don't know somebody that's doing it, you're not in the club, and you really don't know that these things exist. Okay, now you can turn it. So basically once I invested in one, I invested with my IRA, and that's another thing that we don't want to get into today, but that's another thing that financial advisors most of the time don't know about, is that, you can, if you have an IRA that you've rolled over a 401k into from another job or whatever, you can set up what's called a self-directed IRA, and you, instead of Fidelity or Vanguard or whatever, can control what you invest in, and you can make those decisions. And so this type of investment is perfect for that. And although the tax benefits don't necessarily apply because it happens all within the IRA, it's still a great way to diversify. And I do that as well. But my first deal, that's where the big chunk of my money was. I used my self-directed IRA to invest. And then I started, as I said, I learned about it. So once I learned about it, I met with my CPA. I looked at, my particular situation and what I could do. And he gave me a lot of direction and it was worth every dime if you can get a good accountant. That's the key that's one of the keys to life. Not a tax preparer, but an accountant that can really give you advice on what to do and what not to do, that does not offer mutual funds in his own or her own investments. I've found out that that's key too. And you have to pay for these people. You really, it's going to cost more than H&R Block, but it's saved me. It's one of the best. Next to this, it's the best thing I've done. So what I've done, I worked for a long time, 30 years. I was awfully lucky, and I have a nice life. I'm sitting in my house in Woodstock. I have a wonderful life. It's been great, and I really liked my job. I liked my career. I liked the people I was working with. I had a lot of fun. And so what happened was this took on a life of its own. And the more I learned about it, the more I felt like I was called almost. I mean, felt like it was my responsibility to make sure that all my friends and family knew. And so that's over the years, I've gradually moved money into this type of investment. At least me, I couldn't live off of just my 401k. And I think that I'm not alone. And we're the first generation, my generation, that doesn't have a pension, and it's going to be interesting coming up. And my financial advisor, when I started nearing 50, they're all like, buy a whole life policy, buy this annuity, get 4%, all this kind of thing. That's what they were telling me to do, and I did some of it because that's how I was brought up. And when I discovered this, I was like, a stock or whatever, you have to sell the asset to make money. If you buy multifamily cash flowing real estate passively, like what this is, you don't have to sell the asset to make the money. Now, when you sell the asset, that's great. And if it appreciates, that's great. And we've had one of the reasons I was able to retire is we've had a wonderful time in the real estate market over the last 5 years. So it was an excellent time to get into this. But all of that said, if it doesn't go up anymore, I'm okay, right? Because I'm about capital preservation, not having my parents. My parents are an example. I mean, it was horrible. I wish I'd known about this because they did whatever they were supposed to do too, whatever their financial advisor did. And what happened was when they retired, they depended on that stock market money, and the stock market crashed in 2008. And even though they had moved to bonds and all this stuff that was supposed to be safe, it still went down. And so what happened was they needed that money to live on. It's fine if you're 25 years old and you have lots of time in the stock market, but if you're 70, you're in trouble if you have to do that. And so they almost died broke. I mean, it was close. It was really close. And it's really, really unfortunate. So basically what happened was I watched that. All of this stuff happened at the same time, right? I found out about this investment. I learned about this investment. My parents passed away in 2011. It was all of this happened at one time, and I became very enlightened. So through the course of this, I've moved money over from the mutual funds. I've invested in passive deals. I've also done a lot on the general partnership side, which is another conversation, but not much. Mostly telling my friends and family, and that's grown. And so that's sort of my business that I have right now. Now I launched keepmore.com about a year ago, and it's all about keeping more of your money and diversifying into things that frankly we're conditioned to. We're conditioned that our 5, 6, 7, 8% is good, and it's just not. It's just really not. And so I know what a good deal looks like now. I've learned a whole lot, and so I share it. And that's what keepmore.com is all about. And I freely share kind of what I'm up to and the numbers behind all of this. I mean, people. I had a guy who's the head of sales for a major internet company. I mean, forget it. He said, "This is too good to be true. It's got to be too good to be true." And it's not a get rich scheme at all. It's a get rich slowly. But it's really about getting that cash flow and getting the freedom without doing the work. And that's how I kept my boss happy for a long time, because I didn't do any work. I focused on my W-2 job, you know, I really, like I said, you know, everybody was pretty happy for me when I left my job. They knew that my passion had shifted gradually over time, and it was time. And those people are still very close friends today. So, you know, I think that part of what I've learned here with this whole experience is to really be true to yourself, you know, and surround yourself with people that are like-minded, and that are smarter than you. You say that all the time, Dan, and I really do. If you're the smartest person in the room, you're in the wrong room, right? And so I learn something every time I talk to these guys. I don't know everything, but I'm happy to share what has happened to me, and that's the story.
Well, thank you for sharing that, Holly. And, you know, I have a couple of questions that have already come through. And if you're on with us right now on the webinar on Zoom, if you'll go ahead and use the Q&A box and type in any questions that you have for Holly along her journey and what she's presented so far today. I'm going to go ahead and get us started and talk and ask you a couple of questions that have come through. How much time have you, or did you invest on a weekly basis when you were working your W-2 job?
I would none most weeks. I made some visits down to most of the projects that I've invested in have been in my home state of Texas. Coincidentally, there have been a few other places, but you know, I would go down there and look at properties, and all that can be done on a weekend. You know, I did not take that much time. When I started really helping, you know, raise some funds and get investors like I do now, that took some time, but a lot of them, I mean, I really just tell my story and present the opportunity, and that doesn't take much time. And I was in sales, and so through the course of my day, most people ask me about it. A few coworkers, it's funny, a few of my coworkers invested, and one of them now does it full time and has a podcast and everything. And he's like, oh my God. And another one just quit her job on Thursday. So there you go.
So it's definitely possible, because your team definitely, you know, be able to do that. What was your first role in your first transaction that you did?
The first transaction was, you know, Joe Fairless. He quit I remember he called me one day. He said, I'm going to quit my job in advertising, and I'm going to hire this guy to show me how to do this thing. And he found this apartment complex in Cincinnati and called me and said, hey, can you know, I'm doing this. And so I said, yeah, I'll throw some money out of my IRA in there, because I believed in him. And then,
so how much did you believe him in that first investment? So what was that initial investment in that first deal?
I invested $100,000 from my IRA.
Okay.
Now, some people can invest, you know, $50,000. Usually it's around $50,000 or $100,000 per deal. I've invested less in a few of them, just depending on what the situation is and at the given point in time, right? So I've tried to kind of spread it around, but yes, I took $100,000 out of my IRA and I invested in Joe Fairless's first deal. And then he found another deal and found a person, you know, part of this is really getting with people that you know, that people that are smarter than you, right? And that understand this a little better. And that's why the SEC wants you to know the people that you're investing with, right? So that's important. So he called me and asked me to help him raise some money, because he didn't have the investors. Now, you know, he just says, I'm doing a thing, and everybody invests with him, right? Because he's got a ton of experience. And that is what happens, right? Is because what happens is that as you get bigger and bigger, then all the hedge funds want to give you money, and everybody wants to give you money. And so the little guy, not that we're little guys, but you know, average people working W-2 jobs, you just go about life and we don't know about these things. So
So when did you transition from being an LP investor to a GP investor, or be on the GP side?
Probably the second one, because I helped him, raise some money. And then I've piddled around a little bit, over the years, mostly investing on the LP side. And then, I would get my friends, hey, you ought to check on this. And so some of them I'm just on the LP side, some of them, whatever. And occasionally I'd get really into it and work at it. And, over the years now, I've built a database that has been a good jumping off point for what I'm doing now.
So here's another question coming in here that I know you're not a financial advisor or a tax accountant or a tax advisor or anything like that, but I'm going to throw this question out at you because I'm sure some of your investors in the past have probably presented this question to you. Mm-hmm. So the question is, does the income from a 401k funded investment have to stay in the 401k, or can the investor use that income?
No, it has to stay in the 401k. That's why the tax benefits don't apply to the 401k. However, it's still there are not a lot of things. If you're in a 401, if you're in an IRA, they want you to keep in the stock market. So there's not a whole lot, unless you go to a self-directed IRA, there's not a lot of quote unquote alternative investments that you can make with that IRA. I mean, you can do other things. So doing a passive real estate, I just did one with that PPM I just filled out. And that was from my IRA, right? And I'm not going to get tax benefits from that now, but I do believe that, I need places to put money from my IRA because I don't want it all in the stock market. So,
yeah, I think you pretty much already have inherent tax benefits and advantages built into both the 401k and the IRA, which is why you don't get any additional tax benefits by doing these investments.
Exactly. And I'll tell you, I mean, even the stocks have done great. I've made money in the stock market. These can do great too. So
here's another question that's coming through. It says, market was great when you got into multifamily as compared to today's market. How do you see the multifamily proposition in the current market?
Well, today's market is pretty good. So here's the thing. So there are a lot of ways to evaluate deals. The market is getting tighter. However, what I like to focus on are Class B properties. And if you look around at the world, at least in my little orbit, most of the new construction is higher end stuff.
Class A's.
That's right. Most of the new construction are Class A's. And so what happens is that those guys are, for the most part, building that for appreciation. They're buying a plot of land, they're building the really, really fabulous apartment complex, and then they're charging lots of rent, right? And when the economy's good, those things fill up and everybody wants a pool and a tennis court and everything else. Well, we have pools, but you know what I'm saying.
A lot nicer pools and a lot bigger pools.
Correct. And so what happens is that, let's just take 2008. 2008, lots of people lost their homes. Well, so what did they do? Well, they just lost their home. They can afford maybe a Class B apartment like we do, which is you're not getting shot in the street walking out the door. But these are places where, people are the McDonald's managers, the head of security for, the mall, whatever it is, right? And so they're working Americans. And so what happens is that when the economy gets bad, like it did in 2008, people still have need a place to live. There's not very many new Class B apartments being built.
So let's stop here just for a minute, Holly. Can you break down kind of the different classes a little bit? Because I'm sure there's probably a couple people on here that might be new into the space and they're kind of confused as to what's the difference between Class A, B, C, D, all that kind of stuff. Can you break that down real quick for us?
Sure. Let's talk about D first. D is probably the Section 8 housing. These are public housing projects, those sorts of very, very low income types of work. And people invest in those. There's no question. You can make money doing that too. Then Class C, it's C and B. B, sometimes we'll buy a C plus and upgrade it and make it a B minus, those sorts of things. But for C is maybe something that's really kind of in pretty bad shape, and they may not, cash flow right now, and you really need to make some, serious rehabs or whatever. And the neighborhood's not that great, whatever. And Class B, the neighborhood's okay, typically, and it's okay. And there are usually a lot of things that you could make a whole bunch better. Like the first one I toured, I was amazed. It was owned by a hedge fund in New York City, and there was a waiting list for washers and dryers. I mean, how easy is it to put a washer dryer in there? All of them had washer dryer connections, but people were waiting to pay $50 more a month for a washer and dryer in their apartment. They were waiting. There was a waiting list. The hedge fund that owned it up in New York, they don't care about that. See, they're after the big money. I'm after the cash flow. They're after the big appreciation, right? So maybe it was a Class C before they got hold of it or whatever, but they don't care about the washers and dryers. Well, we put a washer dryer in there, pay the rental company $20 to bring the washer and dryer. You got 30 times 300. I mean, do the math, right? And so all of those little things go to the bottom line, and it's really simple to do. And so that's what we do. We build a carport, charge $100 more a month. Easy.
Here's the next question coming in from Alec. His question is, did your experience investing in single family homes help you when you got into the larger syndicated deals?
Well, the only thing it helped me with was that I understood the benefits of real estate investing. So I understood depreciation. I understood that, the same thing. It's very simple. You collect the rent, you pay the bills, what's left over is yours. So all we're doing here is the same thing, only on steroids, right? And commercial real estate is valued. This is important. The value of commercial real estate is valued on net operating income. So if you can get something that's being run that's not efficient, that sort of thing, you can go in and you computerize things, you make it run smoother. You make it a nicer place, build outdoor kitchens and add security and all that. It all makes it a nicer place. And so those sorts of things are a win-win for everybody, right? And so you can really raise the bottom line, because a lot of these, we purchased one from a family. It's a family business basically that had owned it, and the daughter, everybody had passed away. The daughter was in LA or whatever, and she really, she liked the cash flow, but she really wanted her, $20 million, that's what she really wanted. And so, we bought it. So it's those kinds of things, and you get access to them by relationships. And that's why the general partner is so important, because commercial real estate's not like, residential, where you go and you tell the realtor your budget and they show you 5 houses on Saturday and you make an offer on 2 of them and you have a house by Monday. So it's not.
I wish it was that easy, isn't it? That'd be nice.
Exactly. Commercial real estate, this is a whole different ball game. And, I was in sales, my W-2 job, right? And we used to call, I don't think there's children listening, we used to call it a PIA fee, right? It was sort of like, if you weren't a pain in the ass client and you were really good and you didn't hassle us and everything else, we gave you all kinds of good deals, right? And this is kind of this very similar, right? So if you meet all the brokers in the marketplace and they know that you're for real, they know that you're not going to get the letter of intent or whatever, and then go back and try to negotiate stupid stuff. And they know that you're not just, that you really have the money, you really have the investors. They know that you're not going to be a PIA. Well, who do you think, when they get a new listing, who do you think they're going to say, hey, let's avoid putting it on the market. Let's just close this baby, and everybody wins. And that's what you want. And that's how this business works. And so I don't have time. I mean, when I was doing a W-2 job, forget it. I mean, it takes a lot of work, and evaluating deals all the time. And it's a lot of work. But if you invest passively with people that with deals that are underwriting, the questions to ask, you can go to my website and download a little booklet on what I look for, but that's the whole thing, right? And you know, it's a pretty simple process. So
I have another question that's come in here, Holly. It's from Jason. He says, I just turned 25 and bought my first house. It's a triplex that I live in one unit and rent out the other two with a standard 30-year mortgage on it. What advice would you offer someone in his situation or someone who wants to leave the corporate world within a decade?
You're doing the right thing. So I send my daughter to private school in New York City. We have a 4-family house, and 3 of those apartments pay for her private school tuition in New York City, which is ridiculously expensive. So you're doing the right thing. Absolutely. And I would try my best to pocket every dime you can from that. I would still put the most money in my 401k and all this stuff. And you know, I don't know about, so I am sitting in my house in Woodstock, right? We bought this as an investment. We ended up loving it. I love it. It makes me happy, right? So not everything. I mean, could we rent it out and make money? Yes. Do we have equity sitting in it that we probably should use? Yes. I mean, all of those things. Does it make business sense to rent it out? Yes. The people next door are getting Airbnb like $300 a night. It's ridiculous. I don't want to do that because I'm happy here, right? So a lot of this is not all a business transaction, right? Yeah, I got to have fun, but I've never been all that gung-ho about fancy cars and all of that. I'd rather put my money in a house in Woodstock that if God forbid something happened, we needed the money, I could rent the thing out and make $300 a night, you know, and
well, of course, and even in New York City, you don't really want a car because it's too expensive to have a car there.
Right. But when I did, you know, I haven't always lived here. Honda CRVs is what we love, you know, so I've, you know, so life is, that's what I would say is try to cut on things that are not important to you. It may be important to you to have a nice car, but probably there's something in your life that's not as important. So try to cut there and try to just save as much money as you can. And when opportunities arise, listen and take advantage of them and really talk to people that have more experience than you. You're doing the exact right thing. And talk to them about how you can get involved with what they're doing. Just copy what they're doing. I mean, I've never had an original thought in my life. This is all not my, you know, I didn't think of all this. Really didn't. This is totally not my thing. But so find somebody that is doing what you want to do and do what they do. So
that's great advice. That's great advice. So another question here is from John. He says, what tips or golden nuggets have you learned to raise equity as a GP?
I think being, it really helps to do it, be invested myself. You know, I tell my story and I tell people that, you know, what I've done. Now, that's not feasible for a lot of people, but I think that it's the team. It's the strategy. Don't go in with I saw one thing with I happened to be from Houston and they had the wrong school district in the overview. Like, wait a minute, I know that this is not in that school district. It's in another school district. I mean, it's just like a major mistake, right? So don't make sure that whatever your pitch deck or your investor package is, you know, shows that you know what you're talking about, that you've studied the market, that you studied that you know, all the numbers make sense and don't have silly mistakes in there. And all of those things are important. And I think that a track record is good too, you know, and even if somebody doesn't necessarily have a real estate track record, this is a business. Like I learned, I mean, I didn't like, you know, sit in a closet for 30 years. I mean, I understand, you know, business. I understand a P&L. I understand, you know, scaling. I understand, you know, how to, costs and, you know, so I understand a lot of that and building.
So I have a couple of questions myself here, Holly, because I don't have any other questions on the Q&A, but I do have a couple of questions I wanted to bring up with you.
Okay.
So get ready, okay?
Yours are tough.
So Did you try to keep it from your boss in the beginning that you were trying to work this other kind of sides, raising, private capital, raising money for these syndicated deals? Were you trying to keep it from your boss so that you would be able to, so they wouldn't get upset or, think that you had lost interest or something like that, and they might let you go?
So I've always had part-time real estate investor on my LinkedIn profile. People always knew that I was interested in real estate. If you'll notice the last month or couple of months, I've been really posting on LinkedIn. I've been on webinars like this. So I'm much more out in the open, if you will, sort of out of the closet, if you will. But no, I mean, I never really tried to hide anything, call it didn't really advertise. And that's what happened, is that I didn't really advertise that much, but I got more involved in the real estate side, and it was less passionate about my W-2 job. And then it was just really time to, it wasn't fair. It wasn't fair because I love my, I mean, my boss was great and everything. My friends were there, so it wasn't fair to them to be more interested in this. So the time was, it just sort of happened.
So one of the questions that I kind of have been thinking about through the webinar today is about how you in the beginning kind of got started as an LP kind of passive investor, and then decided that you wanted to start to try to come onto the general partnership by raising money for, specifically on Joe Fairless's deals there. Why would you want to do that and continue to, cause you to have to do more work or whatever, versus just continue to stay as a passive investor? Because could you not have still exited as your full-time job just doing passive, or has it been a combination of both of them that has allowed you to be able to exit?
The income I'm talking about is from my passive stuff. Now I've made a little on the general partner. I'm growing that, right? Because my 15-year-old, 14-year-old daughter did make a good point. She said, "Well, Mom, you can live on this, but you were making twice as much." That's a good thought. Smart kid there, right? So I'm growing this because my daughter has 4 more years of high school. What am I going to do? But what happened in the beginning was just really talking to my friends, and when I get passionate about something, it's not really a secret, right? For very long, and that's kind of what happened.
So for somebody who doesn't know somebody like Joe Fairless that's putting these deals together or whatever, and they want to help another syndicator raise money, how do they go about doing that?
Well, you can go to my website, sign up for my email list, and send me a note, and I'll talk to you. I'm sure that Dan, most of the people, Dan, you'll talk to people. I would go to real estate meetups. I would go, the thing that you don't want to do is just say, "Will you mentor me?" And not off, you need to offer some value, right? So
that was going to be my next question for you, is about a mentor. Did you actually have a mentor at that time?
No, I've been doing a lot of what Joe's doing, and then I've met.
He's been pretty much kind of like your mentor along the way.
Yeah, and then now I'm doing what you're doing, and I'm taking my favorite pieces. I've gone to real estate meetups. I've gone to conferences. I've met people. I've found people that my philosophy is, pigs get fat and hogs get slaughtered. I want to be a fat pig, right? I want my investors to make money. I want us all to, I love to go to the casino, right? Just for fun. And my favorite game is Let It Ride, because you play with the dealer. You're working with the dealer to make the thing, and it's not cutthroat like, other things like you lose, I win.
So right now, the way you're making money is mostly from your passive investments that you have as an LP partner, correct?
Yeah.
Okay. And obviously you're making some off of the GP side, and most of that's usually, the benefit for you is really on the capital advance, whether there's a sale or a refinance or something like that. So I kind of understand that piece of it.
Yeah, and it's fun. And then the other thing is I have a company, right? So that I can, again, it's keeping more. It's all about, for me, getting my good CPA, getting taxes. When you have a W-2 job, you just pay more taxes. And I'm in tax hell in New York City. So if I can save taxes, I mean, forget it. That's like a 30%, 40% raise. I mean, it's crazy how between state and local taxes, I don't even want to get into real estate taxes. That's why we should rent this place. But
now all of your income, because now you're classified as a full-time real estate professional, all of your income can now be, offset by those depreciation offsets too, right?
Correct. So the numbers on my tax return, the whole idea is to make less money on the tax return. It's really interesting, right? So the numbers on my tax return are a lot lower. That's good. So
last question for you. Actually, I'll give you two last questions. One just came in here from Alec. He said, how many LPs are too many LPs for one syndicated deal?
I'm not sure. Oh, you mean like individual investors?
Correct.
That's a great question. And I think I don't know. I don't know the answer. I would say that you need enough LPs to raise the money that you need to raise to buy the asset, right? There are obviously fewer LPs or less to manage. It's less, but really the whole idea is to get a good general partner that you trust and that knows, that you think knows what they're doing and has a business plan that you agree with. And there are criteria that I look for. I mean, I turn down more than I invest in, right? So I have certain criteria that it's just not for me. It's not that it's bad. It's just that, ground up construction, I'm not as gung-ho about, those sorts of things.
So I have one more question that just came in. Lots of people are reluctant to invest. What's the most convincing argument that you have made to people who were skeptical?
Well, I show them my tax returns, and I show them my I
love that answer. That's great, Holly.
I show them my bank statements. I mean, I've said, look, here's my bank statement. Look at this. I'm getting these deposits. Call Chase. It's legit. Here, let's just go online and print it out. I'm just telling you that I'm getting $600 a month from this thing. I'm just telling you, just saying. And go talk. I had a investor talk to her CPA. Most CPAs will know what this is. And she took it to her CPA. And most CPAs, if you take it to a financial advisor, forget it. They're going to say, run. Take it to a lawyer. The lawyer's going to point out all the horrible things that can happen, which is what lawyers do. They'll do the same thing with a mutual fund too. Only they really probably won't, because we're all brainwashed to think they're okay and safe. I'm in a safe fund.
Here's another question. If you don't own your investment properties but have an LLC, can you use your LLC as part of your business to pay for deductions and save on taxes?
I don't know. I think that
I think that it would be kind of hard to do that. We're not, corporate attorneys or corporate lawyers or whatever. But from my experience there, you would have to probably do something as the business to be able to have those deductions for it and save on the taxes. I don't know. It's a very specific question. So if you want to, email me after the show, you can do that. Just email me at dan@multifamilyinvestornation.com. I'll be glad to do some research on that for you and give you the best information that I can. Holly, thank you so much for taking some time out of your schedule today. I know you're just very, very, very busy now that you've retired from your full-time job. Yeah. And enjoying your time there in New York City. But we really appreciate you coming on and sharing all the information with us. There's been lots of good questions on this webinar. Looking forward to releasing it out to the rest of the people who weren't able to make it. What's the best way? I guess on the screen here we have your email and your website, holly@mqventures.com, to email her and if any further questions that you might have. If you want to get started with doing some of the stuff that she does, I'm sure she can guide you and direct you in the right way. And also go to her website, keepmore.com. And one thing that I'll mention before we wrap things up, Holly, is about the event that we just announced that we're doing in January of this year. It's a virtual 3-day event called the Multifamily Investor Nation Summit. And you can go to apartmentsummit.com and register for that. Right now, between now and the end of this week, which is our pre-Black Friday or Black Friday special, you can normally the ticket prices for this event is going to be $697. So you can get it for $147 right now. If you go to apartmentevent.com, and you can register for that 3-day virtual event that is coming up January 17th, 18th, and 19th. You'll get a front row seat because it is a virtual event, just like this one is here today. And then we have a lot of high-level speakers there. So if you go to apartmentevent.com, you can see all of the high-level speakers that we have coming on. That will be, and we're getting more and more every day that are actually committing and confirming this. We'll be seeing out more updates and emails and various things like that to update you when we have some of these different speakers. So thank you guys so much. I know, Holly, I saw you just registered for it today too.
I just registered, so go register. It's gonna, and that's the answer, right? If you want to learn more about this, the top syndicators, some of the top syndicators in the country are going to be at this thing. So
I would say the top syndicators will be there because I got some pretty good firm commitments. So, or the person who's going to be kicking it off is actually your first person you invested with, Joe Fairless.
There you go. Can't beat that.
Yeah, I asked him about it, and he goes, Dan, he goes, I don't do this for anybody else, but if it was anybody else, I wouldn't do it. So, but for you, I'll do it. But he goes, I actually carved out 60 minutes for him. He said, I can only do about 20 to 30 minutes. So I'm like, that's perfectly fine. I'm sure people would love to hear from you from a keynote address, even just for 20 to 30 minutes. So
he got famous. He's going to need bodyguards soon.
Oh, I know. Well, he actually has an event coming up as well in February called the Best Ever Conference. So
I know that too. I'm so proud of him. My heart. I mean, little Joe. So proud of him. He's a smart guy. Smart guy.
Funny. Well, again, if you guys want to connect with Holly further, you have her information there on the screen. Email her. We'll go to her website and then also visit the apartmentevent.com to find out more information about the virtual event coming up.
Go sign up.
Thank you so much, Holly, for joining us. Look forward to having you on a future webinar.
Thank you.